Hi, I'm Laurence Parker-Brown. Welcome to the Inside Network. Richard Rauch, Investment Director at Brandywine Global, joins us today to explore an interesting year, 2024, what lies ahead for global investors in fixed income. Thanks for joining us, Richard.
Thanks for having me, Laurence.
So let's start with fixed income. Why now should we be discussing it?
How about for the first time in a long time, we actually have income? If we go back several years, fixed income wasn't giving you anything that normal fixed income investors would be hoping for. Income, total return, diversification, maybe liquidity, you were getting some of that, but the starting point was just so low that it really was a tough asset class to recommend.
And we've seen domestic performance that's been creditable. Why global fixed income investing?
Yeah, so global, it is a very big opportunity set, right? And as the global economy has a multi-speed sort of recovery here, I think there'll be different pockets around the world to take advantage of. Also, the global bond market is generally a bit longer duration than the Australian bond market. And we think probably US is a bit ahead in its cycle than Australia. And therefore, if you see kind of a fall in cash rates, a fall then subsequently, or even beforehand in government bond yields, you're going to see outperformance in other parts of the world.
So you've touched on the global opportunity set. With so many more opportunities that are now offering a real yield that's positive, what role does active investing have to play? Why not look at a passive outlook?
Yeah, look, I think a passive allocation would have been the right strategy last year, 2023, when it was really, trying to get some duration in your portfolio. And it turned out, although it was kind of a wild ride, in the end, it was kind of a coupon year, right? We ended up delivering about what the market would deliver. But fast forward to this year, I think a couple things are happening. There is an increasing divergence in the macroeconomic outlook across countries. And therefore, I guess we think that's going to translate into different performance for different markets, whether it be bond markets or stock markets or credit markets around the world. So this kind of multi-speed cycle, multi-speed recovery is really one of the big themes, I think, of 2024. And just stepping back 1 second, so we've been looking at it's been 4 years since, COVID broke out. We've been looking at this entire period over the last 4 years as one big natural disaster, right? And one big normalization or recovery from that natural disaster. So when you look at the world with that lens, then just normal, traditional macroeconomic analysis, cyclical analysis, really it's dwarfed by what's going on with this kind of deflating and reflating normalization process. We're at the very tail end of that normalization process. I mean, you just have to look at, inflation rates in the US or around the world, Australia, and kind of everything that went up in sequence has been going down in sequence. So it turns out it actually was transitory. It just took a lot longer than most people thought. And so that word might not be appropriate right now. But because of that, we're now in a normal cyclical world, and there's a lot of multi-speed, activity going on in different regions.
One of the things that's quite interesting for investors is what role does fixed income play? For a period, you touched about liquidity, but maybe not offering correlations or real returns. 2024 feels different. What do you guide investors they should be thinking about the role it can play?
I think probably the big one from an asset allocation perspective is at least for the last maybe 10, 20, maybe even 30 years is kind of negative correlation between risky assets or equities really and high quality fixed income is likely going to be in place. And there's good kind of fundamental justification for that. But given that we have a higher yield starting point in most of the world, certainly the developed world, if there is this sort of flight to quality during a crisis, during a recession, during a big drawdown in risky assets, high quality government bonds are going to likely benefit, right? Credit might be another story, but high quality government bonds will benefit. And so that's probably the big one, that traditional relationship from an asset allocation perspective. And I say that with a little bit of hesitation, because if you go way, way back, or you go back over many, many decades or even the century, that relationship isn't always that stable, right? I think most investors know that. But, we think at least in the cyclical window we have ahead of us, that will likely be the case. But in the longer run, right? I mean, you could have a world where investors get really nervous about, let's say, the US or the UK's fiscal outlook, right? They've been borrowing a lot of money. At some point, they're going to have to pay it back, right? And likely an investor will have to be paid a premium to lend to those, governments, to those entities who really don't have the best balance sheets. So yeah, it's a little bit of a mix, but I think there is good fundamental justification for having bonds in the portfolio. And look, just straight up yield, from you could buy short dated, relatively risk-free, if you want to call it that, government debt, 6 months, 2 years, and get 4, 5, 5.5% yields. That seems pretty attractive. You're being paid to wait, I guess, if you're worried about riskier assets like credit or equities.
So you touched on a normalization process, and there's this uncertainty in the market, but it's a time where you need to draw on track records and expertise. What's the investment philosophy that you're working with your team in the fund at the present moment?
Sure. So Brandywine has a pretty strong investment philosophy, and it's all based around value and mean reversion, right? And so why does mean reversion work? And we see it time and time again that interest rates, currencies, and credit markets, they change in value every day. And sometimes they overshoot, sometimes they undershoot. When that value gets extreme, it starts to impact economic activity. And then there's some sort of reaction, whether it's a reaction in the economy, a reaction from a government, a reaction from a central bank, and the wheels go in motion for that to mean revert. And we want to be positioned ahead of that.
That's so interesting. So let's pick that apart. Risk management is agnostic of a benchmark. What does it look like? How do you decide that you don't want to touch something?
Yeah, sure. So, and I would delineate between risk measurement and risk management. So we do both, right? But when people talk about risk management, they're often just rattling off risk measurement, which is some sort of version of tracking error or standard deviation or VAR or some sort of normal distribution-based, metric. And, we have the systems and we calculate these and we monitor them every day, right? But like I said, if your benchmark isn't the right starting point, is tracking error doing you any good, right? Is it telling you, how much risk is in your portfolio? Now, we have a lot of clients that do care about benchmarks and therefore we care. But we think about it when we step back from true risk management is basically not impairing any capital, right? Investing, generating the return that's on offer, describe how I just presented it, right? Mean reversion, value, real yields. So capturing those without giving any away and tearing up capital via defaults, right? And really holding the line when there's markets do their thing, as we saw in the third quarter of last year. Bond markets got away from themselves, right? And a lot of people capitulated and panicked and sold at probably the worst possible time, right? And so you need to ask yourselves every day, has something changed from a pure macro perspective, or is it just a value that's changed? And if it's just a value, then you want to hold the line. And I think that's how we think about investing as a value investor.
So let's look at the values around the world. You've got a global opportunity set. Which sectors do you see as most attractive right now, Richard?
Quite a few interesting opportunities now. First and foremost, high quality government bonds. So we like bonds, not necessarily because we think there's going to be a big bond rally. Now there could be, right? There could be this year. But after a pretty big bond rally in the fourth quarter last year, the starting point does matter here. And what would cause a big bond rally, at least in high quality government bonds, probably a hard landing, right? And so what's a hard landing? A more traditional recession, probably led by the U.S. because most of the other regions in the world have been struggling. The U.S. has been the big growth engine, certainly over the last year, and the big growth surprise over the last year. But if we had a hard landing, then yeah, we could get the 10-year Treasury, 10-year Aussie government bond, rally significantly from here. However, in a soft landing, right, which is maybe described as inflation comes down, nominal growth slows, but we don't tip into a recession. The Fed can take their foot off, and other central banks can take their foot off, the brake, if you will, in terms of their rate hiking cycle. Maybe have some rate cuts through the year. That's the soft landing. The markets basically priced this in, right? Equity markets have basically priced this in. Bond markets, we would think mostly have priced this in, but that's okay, right? Because the coupon is actually pretty good. And if it were another coupon year, yeah, that'd be a pretty good year for fixed income investors, right? If you're yielding, 5, 6, depending on the risk profile, 5, 6, 7, 8%, you just clip the coupon all year, yeah, that's a pretty good return. So high quality government bonds, predominantly US and UK duration. We've been underweight Europe, we've been underweight places like China, but that could change as the data changes. Now, moving on to other sectors, right? More spread sectors or credit-focused sectors. In our flagship, opportunistic fixed income, global opportunistic fixed income approach, we really only buy credit when it's cheap, right? When it's really cheap, screaming cheap. And right now, at least from a spread perspective, we don't really see that. That said, the yield matters too, right? And so for portfolios that do own more credit because the investor wants more of a higher income stream, yes, shorter dated credit, particularly certain segments of the high yield market, the sub-investment grade market, do present some value, right? So we're monitoring it, right? But when you have an 8, 9, 10% yield, you can't ignore that. Moving on, securitized. Probably one of the more boring sectors in fixed income, mortgage-backed pass-throughs. So these are basically just securitized instruments in the U.S. that that the coupon gets passed through to the end investor. They package up a whole bunch of moms and dads have 30-year mortgages, and people like Brandywine can buy them, but they're very high quality, right? They're basically government adjacent, essentially government-backed risk. And typically they trade at only a small margin relative to govies. That's not the case right now. And there's a whole bunch of reasons, technical, what's going on in the US housing market, various reasons why this has been the case. But we really like high quality US agency mortgage-backed pass-throughs. You also get duration with that, right? And you get it at what we think is the right part of the curve, kind of like the belly of the curve as the cycle progresses. Finally, you have emerging markets, and there are quite a few that we've liked, although you have to be selective. In particular, although it has moved quite a bit and has been really the standout performer last year, it was Latin America. And not every country in Latin America, but to name a couple, Colombia, Mexico in particular. Mexico benefits from like the onshoring phenomenon in the US, for example, trades at a higher yield, get some high quality duration. It's actually an investment grade market. Places like Brazil and a few others around the world, probably less so in Asia, but Latin America, both owning the bonds, but if you do it on an unhedged basis, which is the opportunity set we have. So if you buy local government bonds in emerging markets, you get the benefit of an appreciating currency as well. And so those are the kind of things we're doing in the portfolio right now.
So Richard, normalization process, but likewise, you have a philosophy, you have many things priced into the market that you're observing. What's the outlook for 2024?
Yes. So the question everyone is wrestling with is hard landing or soft landing, right? And a lot of this is driven by the US in particular, because that's where we've seen the biggest growth outperformance over the last year. So it's like building a case, if you're a lawyer, building a case for whether, whether someone's guilty or not guilty. On the hard landing side, if you looked at traditional macroeconomic, inputs, it would be pointing pretty aggressively towards the harder landing camp, right? Like a traditional recession. Leading economic indicators, the yield curve is heavily inverted, so on and so forth. But on the other side, the softer landing camp, well, part of the reason why we've seen such good, strong growth outperformance, again, driven by the US, is the fiscal impulse has been so strong. So government spending, right? And although, we think that's going to be coming to an end, it might have a long tail. A lot of these programs put in place during the pandemic have had a very long tail, right? And what's the old adage? Never bet against the American consumer. Well, that may be the case, right? And so it's finally balanced. It's just that markets are very priced for the soft landing right now. All of that said, you can kind of play it both ways, which is why we've barbelled portfolios. We think fixed income does well in either scenario, just probably a little bit better, at least high quality govies, probably a bigger bond rally and a hard landing. But in a softer landing, those other more credit-oriented spread assets perform well.
So global fixed income will do well, whatever the outcome, which is good.
Absolutely.
Let's just quickly explore, quick answer for this one, Richard. In terms of the central bank behavior, are you confident that the policies being taken are accommodating a decent outcome?
Well, central bankers haven't really covered themselves in glory over the last several years in getting it right either, right? And so, you need to take what they say with a little bit of a grain of salt. But also what I like to remind people is that the cash rate is not the government bond yield, right? These are two different things, right? The cash rate is set by the central bank, whether it be the RBA, the ECB, Bank of Japan, the US Fed. Whereas government bond yields, which is what people generally buy, right, are market-based. And they look through all of this noise and kind of make predictions as to where things are going. So if the market sees inflation is falling and they think the Fed is going to be cutting rates down the track, well, guess what? Longer-dated bond yields rally. And you could see a big rally. We saw a big rally in the fourth quarter, see a big rally in anticipation of that rate moving later in the year.
Quick view on the US dollar and the Australian dollar. What sort of moves should investors anticipate this year?
Yeah, so we have at Brandywine a global opportunity set. So we're looking at basically every currency, developed and emerging, and currency is a very important part of our active management process. US dollar clearly is a very important global currency, but certainly relative to the Aussie dollar, this is actually a view we have right now. We've been overweight Australian dollars. And a little bit of this is a relative value view. So overweight Aussie versus Kiwi, for example. The Australian economy looks like it's outperforming for various reasons. But relative to the US dollar, we think that the inflation is stickier here. We think the RBA might have to keep rates where they are longer than the Fed over the course of the year as the cycle unfolds. And then more broadly, the US dollar, look at any valuation metric, and look, Brandywine, that's where we start, right? The US dollar looks overvalued. This is not news to most people. By almost any measure, it looks overvalued. But that doesn't mean it can't keep going up. However, these cycles tend to last for, a decade or decade plus, where the US dollar goes up, US dollar goes down. I think we might be approaching a period, and remember, currency is a relative game, where US dollar and US growth dominance, US dollar outperformance may be coming to an end. And if that happens, as that happens, other currencies around the world look more attractive.
So what are the surprises that investors should be cognizant of as 2024 unfolds?
I think one of the big surprises last year was people just got too pessimistic, right? And, when people are putting these outlooks for a new year together, they often have these sort of shocking titles oh, what's the big surprise that's going to happen? Or it's going to be very unpredictable. Markets are going to be volatile. What if it's not? What if it's not that volatile? What if it basically just plays out kind of in a straight line? Well, if it does, at least economically, markets are kind of priced for that. So it might just be a boring year, right? That might be the big surprise. And if it's a boring year, you get your coupon in fixed income. And that's not a bad place to be.
So a lack of surprises could be a good thing. Thank you so much, Richard, for all of your insights. And we'll look forward to hosting you again soon.
Great. Thanks for having me.